Welcome to the Deep Dive. Today we're taking a look at Pool Corp, the ticker's Pool.
Right.
And what makes this one pretty interesting is that Warren Buffett's Berkshire Hathaway, well, they recently invested.
Yeah, that always gets attention.
It does. And this company has this, incredible lifetime return, something like 42,000%.
42,000%. It's kind of staggering, really.
Exactly. So our mission today is to really understand what's driving that success and maybe figure out if it's still a compelling investment for you listening. We're digging into a recent Motley Fool article for this.
Sounds good. And Pool Corp, it might not sound like the flashiest company, right? No cutting-edge AI here.
Definitely not.
But fundamentally, they are the world's largest wholesale distributor of swimming pool stuff. Equipment, parts, supplies, the whole 9 yards.
Okay, the largest.
The largest. They've got a huge network serving something like 125,000 wholesale customers.
Wow.
And not just in the U.S., we're talking Canada, Mexico, Europe, even Australia.
Yeah.
They're dominant.
Okay, so dominant. Let's get into the nuts and bolts. Where's the money actually coming from? What are the revenue streams looking like for, say, 2024?
Right. So the breakdown is interesting. New construction, building new pools, installation, that's about 15%.
15, okay. Seems kind of low, maybe.
Well, wait. Then you have upgrades and remodels, people fixing up their existing pools. That's another 20%.
All right, so that's 35% combined for building and fixing.
Exactly. But here's the kicker. The biggest chunk, a full 65%, comes from supplies and maintenance.
65%. Just keeping pools running.
Pretty much. Chemicals, filters, cleaning supplies, all the ongoing stuff. And what's really fascinating, the article pointed out back in 2014, that number was 60%.
So it's actually grown from 60 to 65%.
Yeah, that little shift tells a big story. It really highlights how powerful their recurring revenue model is.
Recurring revenue. The magic words.
Totally. Think about it. Every single new pool that gets installed, whether they did the initial parts or not, becomes a potential long-term customer needing that constant stream of supplies, week after week, year after year.
Right. It creates this really stable base, doesn't it?
Yeah.
Much more so than just relying on, say, new home builds, which can be very cyclical.
Precisely. The article uses this great analogy, calls it a spinning wheel.
A spinning wheel. How so?
Well, each new pool installation gets the wheel spinning, right? And then it just keeps turning, generating that continuous flow of revenue from supplies and maintenance long after the construction crew leaves.
I like that. So even if the economy slows down and fewer new pools get built.
That big 65% chunk keeps generating cash flow. It gives them a lot of resilience.
And does that large, steady demand for essential supplies give them some pricing power, maybe?
That's a really good point. When you're the market leader and people need your chlorine or whatever week in, week out, yeah, you probably have some leverage there. People might grumble. But switching suppliers isn't always easy or worth the hassle for basic stuff.
Makes sense. And the scale here is just enormous when you think about it. The article mentioned, over 11 million bodies of water in the U.S. alone?
Yeah, it's a huge number. And specifically, 5.4 million in-ground swimming pools. Just in the U.S.
And Pool Corp is the leader.
Yeah.
But the article said the industry is fragmented. What does that really mean for them?
Fragmented just means there are still lots of smaller independent distributors out there, mom and pop shops, regional players.
Okay.
For a giant like Pool Corp, that's actually a big opportunity. It means they can keep growing by buying up these smaller competitors.
Consolidation, a classic strategy.
Exactly. They can use their scale and resources to acquire these companies, expand their footprint, gain more market share, probably get some cost savings too. It's a proven way to grow.
Right. And that kind of fits with their financial strategy, doesn't it? It sounds like they run a pretty efficient ship.
Yeah, they seem to. They generate a lot of cash flow.
But the business itself, distributing supplies, doesn't sound like it needs, constant massive factory upgrades or R&D spending.
Probably not as much as, say, a tech company. So they end up with this strong cash flow, and the question becomes, what do they do with it?
And the answer seems to be
very shareholder-friendly. They funnel a lot of it back through stock buybacks.
Which helps boost their earnings per share.
Right. And also through dividends, giving cash directly back to investors. This discipline in how they use their cash has been a huge part of that amazing long-term return you mentioned earlier.
Okay, but we can't just look at the past. What about now? The current economy.
Well,
It's got some challenges.
for sure. The article touches on that. Things like consumer sentiment maybe dipping a bit, higher interest rates.
Yeah, higher rates definitely make big-ticket items like a new pool less affordable, right?
Yeah.
A luxury purchase for many.
Absolutely. And that does raise questions about their near-term performance. In fact, the first quarter of 2025, they did see sales and profits decline compared to the year before.
Oof. Okay, so a dip.
A dip, yes. But here's the interesting part. Even with that Q1 dip, management came out and reaffirmed their full-year earnings guidance.
They stuck with their forecast, the
Yeah.
one they made back in Q4 2024.
Exactly. They're still projecting earnings per share between $11.10 and $11.60.
Which is up from 2024's actual number, right? Wasn't that $11.07?
Correct. So they're guiding for growth year over year, even after that slower start. Now, it is still below the peak they hit in 2022, which was way up at $18.43.
Okay, so not back to the absolute peak, but still forecasting growth for this year.
Right. And the timing of that reaffirmation is pretty key, I think.
How so?
Well, they reaffirmed it just before heading into the peak swimming season. Q2 and Q3 are their biggest quarters.
Ah, good point. So it suggests they're pretty confident that the core business, especially that big maintenance and supply part, is going to hold up well enough through the summer to hit those targets.
That's how it seems, yeah. A signal of underlying confidence despite maybe some softness in new builds.
So even with profits maybe bouncing around a bit due to the economy, the valuation angle gets interesting. The article suggests just looking at short-term profit swings might be misleading.
It can be, yeah. But what stands out is their dividend record. That looks really solid.
They've been raising it consistently.
For 14 straight years, apparently. That kind of track record really speaks volumes about their financial health and commitment to shareholders,
14 years is impressive. And the yield right now, the article mentioned it was pretty high historically.
Yeah, about 1.6%, which for them is the highest it's been in over a decade.
Okay, but sometimes a high yield can be a warning sign, right? Like the stock price fell because the business is struggling.
It can be, but you have to look at the payout ratio, too. That's the percentage of earnings they're actually paying out as dividends.
And for Pool Corp?
It's less than half of their 2025 earnings guidance, so they're easily covering the dividend with plenty left over.
So the higher yield looks more like potential value rather than high risk.
That seems to be the argument, yes. It suggests the dividend is sustainable, maybe even growable, and the stock might be attractively priced relative to its history and earnings power.
Got it. And then sort of the elephant in the room, or maybe the whale, Warren Buffett.
Right. Berkshire Hathaway taking a stake in the third quarter of last year.
That definitely adds a layer of, validation, or at least intrigue.
For sure. When Buffett or his team invests, people take notice. Their whole philosophy is about finding companies with, durable competitive advantages.
Moats.
Exactly. Strong management, predictable cash flows. The fact that Berkshire bought into PoolCorp suggests they see those qualities here. That dominant market position, that reliable recurring revenue, it fits the mold.
Okay, so let's try and wrap this up. Bringing our deep dive on PoolCorp to a close, what are the key takeaways?
Well, I think it boils down to a few things. First, that success is really built on that incredibly reliable recurring revenue stream from supplies and maintenance. That's the bedrock.
Right, the 65%.
Second, their leadership position in a fragmented market gives them a clear path for ongoing growth through acquisition.
The consolidation play.
And third, they have this shareholder-friendly approach, returning cash through buybacks and that consistently growing dividend.
Makes sense. And while there are definitely some economic headwinds right now,
Yeah, can't ignore those.
management seems optimistic, sticking to their guidance for the year. And that dividend yield, as we discussed, looks potentially attractive rather than risky.
It presents an interesting picture, for sure. It really highlights how businesses providing essential, sort of mundane, repeat services can be incredibly powerful investments over time.
Yeah, sometimes the most compelling stories aren't the flashiest ones.
Absolutely. Less glamour, maybe, but consistent results.
Which leads us nicely to our final thought for you listening today. Think about that long-term potential. Companies that build those sticky customer relationships through necessary recurring services. Even in industries like pool supplies that you might not think about every day. What other everyday industries might be hiding similar gems? Businesses quietly compounding value for investors who are focused on the long game. Definitely something to chew on.
Good question to leave folks with.
Thanks for joining us on The Deep Dive.